Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to learn about what is Forex derivative along with its uses, importance and types. Okay, a very important topic for all the students who are learning international finance and want to clear the doubt what is based on Forex derivative. Okay, so chalo, we'll start with the first introduction. Ki what is Forex derivative? Then we'll see what are the uses, what are the types. Chalo, so let us start with what do you mean by Forex derivative? Now, let us learn first what are derivatives. A derivative is a financial contract that derives its value from an underlying asset. So it is basically, a financial contract which is deriving a value from an underlying asset. Now, to understand this term underlying asset, okay, we will be taking up, a special topic as we go through this topic of derivative. We'll have a better idea about this term underlying asset. Now, under derivative, the buyer agrees to purchase the asset on a specific date at a specific price. Now, this is a very important point under derivative. Key the buyer agrees to purchase the underlying asset on a specific date. Now, the date can be any future date or the present date at a specific price. Okay. So, under derivative, okay, first of all, there has to be two parties. Secondly, the buyer agrees to purchase the asset at a specific rate and at a specific price. Now, when we are talking about the underlying assets, now what are these assets and what does it include? The assets include commodities. Commodities can be in the form of oil, gold, silver, then stocks, bonds, interest rate, and currency. So when we talk about underlying asset, we are covering up all the types of commodities, all kinds of stocks, all kinds of bonds, interest rates, and currencies. Now, the derivatives is basically used either for risk management, which is also termed as hedging, where you're trying to, you know, lower your risk, or for speculation. Now, speculation is, another term used for betting. You are assuming that in future the price may increase or decrease. So based on your assumption, okay, you are trying to speculate the market, and based on that, you can buy a particular asset at a specific date and at a specific price. So this is known as derivative. Now, let us learn what are the various types of derivatives. Now, in the market, there are various types of derivative available, but among them, these four are the most important one. Number one is futures, second, forward, third, options, and fourth, the swaps. So these are the four important types of derivatives that we need to learn, which are traded on regular basis in the market. Okay, now let us learn how are derivatives traded. So the financial derivatives in current scenario are traded on two terms. The first, the derivatives are traded on a term called as over the counter or OTC. Here the trader, the buyer and seller, okay, trade face to face. Now this is a bit riskier, okay, because it depends on person to person. Okay, so over the trade counter or over the counter trade of derivative is a bit more riskier. Okay, it can also be known as a direct trade because here the buyer and the seller face to face trade off. They are risky because it depends on person to person. That is the first type of trade which takes place under derivative or financial derivatives. The second trade off option is the exchange traded derivatives. Now, what is the meaning of exchange traded derivative? Now, here the derivatives are traded on, on a standardized platform such as the stock exchange. Now, this is a much lesser riskier than the over-the-counter trade. So these are the two types of financial derivatives available. One is the over-the-counter. Second one is the exchange traded derivative, or that is also known as the ETD. Now let us learn what are the various uses of derivatives. Number one, the risk aversion tool. One of the most important services provided by the derivative is to control, avoid, shift, and manage efficiently different types of risk through various strategies like hedging, ar- arbitraging, spreading, etc. Now, again, derivatives is basically used for your risk management stuff. That is by hedging, where you are trying to protect your risk. Arbitraging, again, similar concept. Spreading is again, the difference between the buying and selling. Okay, so derivative is basically used for your risk aversion tool. Next, prediction of future price. Derivative serves as barometer of the future trends in prices, which result in the discovery of new prices both on the spot and futures market. So as a result, they assist in appropriate and superior allocation of resources in the society. Derivative helps basically in predicting not only the spot price but also the future price. Thus, it helps you to find out both the spot as well as future market. And okay, as a result, it assists in appropriate allocation of resources in the society. The next use of derivative is that it enhances liquidity. As we see that in derivatives trading, no immediate or full amount of transaction is required since most of them are based on margin trading. So under derivative, you're not going to actually pay the full amount, okay, costing of your asset, but you're basically trying to pay off the margin. So as a result, large number of traders, speculators, arbitrageurs, operators in such market or operates in such market. So derivative trading enhances the liquidity and it reduces the transaction cost in the market for the underlying asset. Since you're not going to pay, or since you're not going to immediately pay the full amount, okay, a large number of traders, speculators and arbitrage operate in such market, and it enhances much more liquidity and it reduces the transaction cost. The next use of derivative is that it assists the investors. The derivative assists the investors, traders, and managers of large pools of fund to devise such strategies so that they can make proper asset allocation, increase their yield, and achieve other investment goals. So this is a very important use of derivative, that it assists the investors to come up with such good strategies which are required for proper asset allocation so that they can increase their yield and achieve the investment goal. The next use is that it is like a catalyzed growth of financial market. The derivatives trading encourages the competitive trading in the market, different risk taking preference of the market. The derivative trading encourages the competitive trading in the markets, different risk taking preference of the market operators like the speculators, hedgers, traders, arbitrators, etc., resulting in increase in trading volume in the country. So they also attract young investors, professional and other experts who will act as catalyst to the growth of financial market. So derivative, it encourages good competitive trading. So it result in huge volumes of trading in the country, and it can act as a catalyst to the growth of financial market. Okay, next, it brings perfection in the market. Lastly, it is observed that derivative trading develops the market towards complete markets. Now, let us learn various types of investors in derivative market. Now, in a broad sense, there are three types of investors in derivative market. Number one, they are known as the arbitrageurs. Now, what are arbitrators or who are they? This investor buys an asset at a cheaper rate from one market and sells it at a higher price in another market. Here, the investor is taking the minimum risk. This price gap is very brief and it narrows down quickly, and the arbitrator might lose the opportunity. For example, if a share XYZ is trading at 100 rupees per share in cash market and rupees 102 in future market. So at spot rate it is 100 and in future market it is 102. So here the arbitrator would buy XYZ share at 100 rupees from the cash market and sell it at 102 in the future market, hence making rupees 2 profit per share. So here arbitrator is nothing but a person or an investor who buys cheaper, who buys an asset at a cheaper rate from one market and sell it at a higher price in another market, and thus earning the difference is nothing but the profit that he'll be earning. This is the first type of investor in derivative market. The next type is known as the hedger. Hedging is minimizing the risk or loss, as we have learned earlier also. In market, an investor who protects his investment from unfavorable price movement is called a hedger. So any person who tries to protect his investment, okay, from the volatility of the market, he is known as the hedger. So the hedger tries to limit the risk by buying put options by paying a fixed amount known as premium. For example, an investor has a portfolio an investor has a portfolio an investor has a portfolio of rupees 5 lakhs. Now to protect his portfolio from volatility, he can short index futures to make his portfolio beta neutral, or he can put or he can buy put option by paying a fixed cost known as premium. So hedger can use either short index futures or put option in order to save his investment from the volatility of the market. So this was the second type of investor in derivative market. Now the third type of investor in derivative market is known as the speculator. Now, who are speculators? They are the risk takers. They take high risk, expecting higher gain in short term. They buy stock with an expectation of they buy stock with an expectation of price rise and sells them at a high price level. So it is basically like a betting. You are expecting it you're going to you are expecting that the price of a particular asset will increase in a short period and you're trying to bet on that. This situation can make high gains for an investor, though it also has very high risk of losing your money. So if you're betting or if your assumption is not correct, if it goes the vice versa of what you're thinking, then you can go into heavy losses. For example, if a speculator feels that the price of ABC company is likely to fall in a few days due to some upcoming market developments, he would short sell the ABC company share in the derivative market. Now, if the stock price falls as expected, then he would make a good profit depending on his holding. So, depending upon how much holding he'll make profit in that case. However, if the stock price goes up against the expectation, then his loss would be equivalent. So these were the three different types of investors in derivative market. The one is the arbitrators, second are the hedgers, and third are the speculators. With that, we will be ending this video here. Thank you.